So I want to say welcome to everybody. This is Dennis Wilburn with the Active Trend Traders on the How to Make Money Trading Stocks webinar. Joining me from Dallas is Mike Traeger, who is my research partner, and we do a lot of chat about what the market's doing. Mike, how you doing?
Hi, thank you. Doing fine, having kind of a rainy, wet, gray, windy morning here in Dallas.
Wow. And so, well, it's windy here, but the sun is shining. So, of course, uh, the California, of course, probably most people know is having a severe drought and all that kind of stuff. And it was kind of interesting. I read an article this past week said uh, why instead of developing that bullet train that'll go from L.A. up the San Joaquin Valley to San Francisco, why not put those funds towards doing some desalination plants like they did over in Saudi Arabia? And it kind of gave a pause for thinking about that, because it almost seems like a no-brainer to, especially with some of the advances in desalination.
Yeah, I'll tell you why that's not going to happen. It's because it's California, and excuse me on my soapbox, but the liberal environmentalists are going to so totally squash the desalination thing, and talk about all the environmental benefits of the bullet train, and it's just going to be a very long, drawn-out process if it happens at all.
So you don't think they have any environmental fundamentalist or activist in Saudi Arabia?
Not like California.
Okay, so let's get going. Want to remind everybody that all the materials presented are for training purposes only. Got some great charts to show you today. Traders should paper trade any new method prior to the risk of their own personal capital. I don't talk that much about the rest of the disclaimer, but it basically just gives a disclaimer required by the government, and covering both that basically say that um, what we show are not necessarily recommendations, but they're observations, and also just sharing what we trade, and also a little bit about the risk involved in trading options. So we've been having some good Wednesday night sessions, Mike. This coming week that we've got coming up, we're going to cover strategies to build up a small account. So for premium ATS members or folks who want to join even for the on a trial basis, that is an excellent way. But strategy to build up a small account, and I'm going to be focusing on an account of about $2,000 and what can be done with that to both generate growth and income to grow it into a larger trading account. This past week we covered weekly and monthly charts to improve entries. Mike, you were telling me that in doing that or being on that webinar, what were your takeaways from those utilizing those longer term charts to improve your entries?
Well, there's just more data incorporated into a weekly or a monthly, the longer term chart, and it's easier to get an overall view of what the forest looks like, and not get caught up in the trees,
Yeah.
so to speak, of the daily or the intraday charts, and certainly easier to see areas of significant support and resistance, just because there's more data being displayed over longer time frames on those longer term charts.
Yeah, and one of my takeaways as I was reviewing and putting those slides together was the criticality of keeping the monthly and the weekly chart at least in view when I'm throughout the month, because the hidden levels of support and resistance that show up, the stronger levels of support and resistance that show up on a weekly and a monthly chart is you're not going to see it if you're looking at the noise of a daily or an intraday chart.
Well, yeah, right, exactly. That's my point. And certainly, there's nothing wrong in my mind when you see areas of significant, in an uptrending market, and you see repeated pullbacks to a certain support price level over a period of several months, which would show on a weekly or a monthly chart, of even throwing an out to your broker that can sit there for a while and say if this entity, whether it's an individual stock or an index ETF, if this entity comes down to this price, I want in, even though that may not happen for several days or even a few weeks. You can anticipate that by reviewing the longer term charts and not have to be in front of your computer every day to put the order in when you have that kind of bigger picture perspective.
Yeah, right on. And one of the other things is the longer term charts give you a really good perspective of the longer term real trend, because I know if you're looking at a short time frame like a 3-month or a 4 or 6-month daily chart, the chart may be really ugly and it appears as if the stock is in a real severe downtrend, or maybe a severe, you think it's running up and doing a great uptrend, which it may be on the short term, but by having the longer term chart up there, like a monthly or a weekly, especially the monthly, you may be able to say, oh, well, this is just a pullback within a longer move. And because oftentimes I see people, they pay attention to the 3-month, the 6-month chart, and it's they take, let's say, bearish trades because the chart appears to be bearish, but it gets down to a level and it just reverses real hard, and there's left there scratching their head going, what the heck happened to my short trade? I just lost money on it. And a observation or an analysis of the longer term chart would have said, aha, there's a strong level of support there. No wonder it bounced. I should have been long. So anyway, I guess that's kind of the free stuff for today on long-term charts.
Yeah, and I'll add one more thought to that. I mean the early warnings alert system and timing service that we've implemented really sort of ties into all of that, because essentially what we're trying to do is buy into weakness, buying pullbacks in what has been an overall uptrend in the U.S. equity markets that has persisted for well over 100 years, and you can't fight that uptrend. We're just trying to buy the oversold pullbacks, within that.
Right on. And so and sort of so far we've had 2 alerts this year so far. We're up nicely on those trades. So this week in the market, I have to say that tech rules. The technology stocks, as we've seen, or those with a relationship to technology. I don't really consider Amazon a technology stock, although one can argue the point that it is and not. I have to give them kudos. Their research is absolutely amazing, and some of the things they're doing in getting drone deliveries and all that kind of stuff for packages. I have to say that they always stay kind of on the cutting edge. That's what makes Amazon so exciting. The S&P, we basically are at resistance. The Nasdaq and the Nasdaq composite broke out nicely, and we'll be taking a look at a reason why it broke out here shortly. The Russell, no breakout, kind of, and again, we'll have to take a look at the chart to see what that entails. Influences going into next week. I think one of the biggest influences for the tone of the market next week, Mike, is going to be Apple's earnings, which happens on Monday after market close. I think that will be it may very well be the bellwether that sets the tone of the market the rest of the week.
Well, not only the rest of the week, but for several weeks going forward. I mean, there's no question that just in terms of its market cap and its size, Apple has an undue influence on the indexes,
Yep.
including the Dow these days. And whatever happens, whatever the price action response is to Apple's report, is going to have a big influence on what the indexes do.
Without a doubt. And so there's still also, there seems to be a this, the bad news inverse, that we're in bad news inversion territory. In other words, bad news is good news is bad news, type of thing, because we're still dealing with the potential of rising interest rates here in the U.S. Now the talking heads are saying that the next rate increase will probably come in September rather than June. We'll see. And then there tends to be a all's good mentality. Folks are definitely looking for anything that has bad news. They look for the silver lining in it. And this isn't a criticism. It's just that's what it seems to be. I received an email a little bit earlier today, and I want to thank the member who sent that in. It was talking about on the Independent Investors of America, the IIAA or something like that. They're showing that one of the things they measure is the sentiment of investors, and right now it's neutral. In other words, and it's been neutral for above the certain level for some time. It's like above 45 or above 55%. And that when that happens, I won't say it's a catalyst for the market to go up, but the market does continue to go up until it actually gets up into a more elevated area. We shall see. On the non-weighted indexes, the number of stocks participating is still below 70%. We'll take a look at that. And what does that tell us from an internal standpoint? Is while we have the big breakouts in Nasdaq and all that kind of stuff, which is a weighted index, not all the stocks are participating. Matter of fact, the big jump in the Nasdaq today can basically be related to 3 stocks. And so here's where we were last week. China resting or cooling off, still an issue, still a question mark of what's going to go on. So here's the reason why the Nasdaq gapped today. Well, one is Google reported, and it was up significantly. Amazon reported, and it was up like over $50. And then this little, but not that big of a thing, but number 16 on the list, Starbucks reported and gapped up. And so right there, we're talking about 11, almost 13, 14% of the NASDAQ had at least positive reaction earnings. And when Google gapped, Amazon gapped, Starbucks gapped, what happened was the NASDAQ and the composite also gapped. But look at this weighting, and this is why I say Apple may very well set the tone for what's going to go on next week. Look at the weighting of Apple on the NASDAQ, 11.55%. Mike, you're more familiar. What's the weighting based on?
On the NASDAQ, the weighting is based on the market cap.
Yeah.
So, I mean, Apple being, in terms of its market value or market capitalization, being, the largest company or largest stock on that metric, I think, in the world, is what accounts for that. And I think by itself, Apple, if I'm not mistaken, accounts for about 4% of the S&P 500.
Yeah. And but not nearly as much as, of course, you're the NASDAQ. And so next month, like I said, after next Monday, it will probably set the tone for what's going to happen throughout the rest of the week. And they rebalance this occasionally, but you can always go to the NASDAQ website and just ask for what the weighted, it'll typically give you the top 25 stocks that are in the NASDAQ and how they're weighted. But as we can see, Apple is the big dog in the yard, isn't he?
Yeah, you know, it's amazing to me looking at this information, this slide that you've got up here. I mean, if you add up the top 5 or 6, and I'm just doing sort of rounding and ballpark numbers here, I mean, you know, 35 to 40% of the Nasdaq index is comprised of 6 stocks.
Yeah.
And I just find that incredible because I know there's approximately, I think, 3,000 stocks in the NASDAQ Composite Index. And to have, you know, 6 of them accounting for, you know, a third of you know, what that index is doing is just mind-boggling.
Yeah, and it may be even weighted more than that, Mike, because this was the Nasdaq 100 that I picked up the weighting on this, so it's not even the composite.
Okay.
But
Okay. I think for the full composite index, which is what I'm thinking of, the numbers might be a little bit different, but still, you know, you've got, you know, the top 5 or 6 in the Nasdaq composite, and I think Facebook is one of those now, which is not on the slide.
It is. Facebook is on it. It's right down here.
Down there. I think Facebook has a bigger influence on the Nasdaq composite as opposed to the Nasdaq 100, and even with the Nasdaq composite, I think the top 5 or 6 account for like 25% of the index.
And so, and you know, and I'm going to scratch off that one. I'm going to scratch off that one. Scratch off that one, because well, it's questionable whether they're growth stocks anymore. They're just kind of like they're big caps. I mean, nowadays. But any of these other ones are market movers, and so I guess Cisco and Microsoft and Intel can be market movers also, but you know, their best games are probably behind them as far as growth goes. So let's take a look at, this is where we were last week. We had basically broken down, and I was going, oh, great, finally we're getting some traction to the downside. Then this week happened. This was Friday of last week. And then we basically have made a steady little climb back up from where we fell from last week all the way back up to this current area. This is what I'm talking about. We're still operating within this downtrend for the highs. Now, Mike, you said you had done some additional research on another chart that was kind of like this, but also painted a picture that the participation of stocks in the particular uptrend, if you just take it non-weighted, is again similar, that you know the participation of stocks is actually in a downtrend rather than an uptrend.
Well, you see, I see this kind of, you know, similar picture. You know, the percentage of stocks above the 20-day moving average. I mean, there are also charts you can look at that show the percentage above a 50-day moving average or above a 200-day moving average, and there are websites you can go to see that. But they're all showing the same kind of thing. And I mean, you know, the indexes, as we've been talking about, which are influenced by a few fairly large stocks, are you know, making higher highs, but the overall breadth behind those moves is very unimpressive because there are fewer and fewer stocks participating in these moves. We're getting lower highs in these percentage of stocks above, you know, certain moving average measurement.
Yeah.
And in fact, I even saw an article I was, you know, reading a little bit earlier this week that specifically looked at the percentage of stocks above the 150-day moving average. You know, we talked about looking at, you know, weekly and monthly charts, you know, longer-term charts to get a bigger, you know, overall picture perspective. And so I was curious and looking at charts that are above a 150-day moving average, above a 200-day moving average. Well, you know, this whole run in the markets that we've seen in the past 2-3 years, going back to 2012, 2013, as the indexes have been doing nothing but putting in higher highs, the percentage of stocks above the 150-day moving average for 2 or 3 years now has been putting in lower highs and completely diverging from the index price action, which shows that even over the longer term, you know, the breadth behind this move the last 2-3 years just really isn't there. And again, typically, when we've seen those kinds of long-term divergences in the past, I mean, it reconciles at some point. Reconciling meaning that the markets wind up breaking to the downside and correcting at some point in time.
Yeah, well, I mean, that I agree with that wholeheartedly. That eventually, at the same time, right now, hey, the uptrends are intact on the markets and indexes themselves, and the challenge is just finding those stocks that are moving with the uptrend of the market. But I spent a lot of time with the IB 50 and the running list. And when you take a look at those, I find stocks that are, even on there, that they're very divergent. They're either really, really, really healthy and doing real nice uptrends, or they're showing really, really strong weakness. Strong weakness, is that an oxymoron?
Well, yeah, I know what you're saying. And even today, we're sitting here talking about the markets today. I mean, the S&P's up. The Nasdaq certainly is up and appears to be breaking out, but the Russell Index, which is not as heavily influenced by a small handful of stocks, is actually down slightly.
Yep.
And not putting in a higher high. And I find that to be pretty interesting.
So, yeah, one of the questions, and I know that this, sometimes comes up, is the question being, well, what happens if the market straightens itself out? Can't some of, there is the potential, of course, that the stocks that have been basically weak while the leaders have been, racing, off to the races, that eventually those weak stocks will get, will click in, and then they'll come in to support more rally on additional rally on the market. What do you think of that thought, Pat?
Well, and anything's possible.
Okay.
And these days, I mean, I'm beginning to think that we're really in uncharted territory here in a couple of different ways. Uncharted territory in terms of price action on the indexes.
Yep.
Uncharted territory in terms of the influence of the central banks.
Yep.
And we have historical examples to show us what has happened in the past when things have gotten the way they appear to be in the markets now. We don't have a lot of historical precedent for some of the influences on the market. So what you just said about maybe some of the weaker stocks. Yes.
Yeah, go ahead.
Oh, well, yeah, certainly it's possible some of the weaker stocks, could kick in instead of some of the stronger stocks being brought down. I mean, anything's possible.
Yeah. Yeah, because there definitely seems to be motivation on the parts of governments and all that kind of stuff to keep the market from falling. And so, hey, if that's the case, then enjoy the ride while it lasts, and eventually it will show up on the charts when things, and the clues will come together, and you'll go, aha. So here we are. This is S&P, right up at the top of the resistance box that we had drawn in here about almost a month ago. Back in the March timeframe, we drew this in, and clear enough, we came up into it. Last week pulled back. Again, this pullback was very short and shallow, and a resounding rebound the rest of this week. And we're right back up at the top of the box. If we break out from there, then the S&P probably has has more legs to the upside. But right now we're just situated right there. Again, if we close there, what to expect on Monday? Expect the market just kind of fuddle around until after the close when Apple reports. But the initial bearishness of we get this breakdown now has been returned, and all the moving averages now are facing going up in a bullish motion, an uptrend. And so the stack of the moving averages, the whole moving average, the 8-day and the 20-day, and of course the 50-day is down here somewhere, are all headed up in a positive direction. What do we got going for the, I'm going to do the Russell first. As you can see, Mike has been talking about, I talked about the Russell breaking out kind of. Well, go ahead. Yeah, here's.
Who me?
Yeah, did you say something?
No.
Okay. So here's what we got going on the Russell. One, this level at 1267, it was a strong level of resistance, in which we stuck our head above, the Russell stuck its head above yesterday, and it had also done that earlier the week before. But taking a look over here, and this is what I was talking about, that Mike and I were talking about, is as you see the closes on the weekly basis over here, you can see that there has not been a close actually above that 1267.88 level for 1, 2, 3, 4, 5, 6 weeks. And again, it appears as if it is either going to drop below it or just stabilize right there. Last week's bearish, almost bearish candle, which was a dark cloud, is still in effect because we have not taken out the high from that day. And what do we got going over here, Mike? We've got basically the true strength is just kind of going flat. And then also momentum is kind of just flat. We haven't turned down totally. On a daily chart, though, what we're looking at is we made this high here, which gave us a this high, and you basically have got flat momentum or to slightly down for a bearish divergence. I think that's slightly down or about level. And again, same thing on the true strength indicator, which measures some of the internals of the price action, and it's staying above the zero line, which means it's still in an uptrend, but it's not spring loaded to the top. Even during this move up here, it was done so with just kind of meandering or mediocre momentum, both on the momentum indicator, which was actually going, it was going lower as this was going higher. It spiked, and then it's fallen off. So that's what's going on with the Russell. We shall see if what goes on with the Russell through the rest of the day. We may have a mixed market. The market by IBD standards is in, has been said it was in a confirmed uptrend again. And this is the gap I was talking about on the Nasdaq. The Nasdaq, this is the Nasdaq 100. And as we take a look at that, it's looking kind of positive, Mike. It's looking like, hey, I'm pushing in new highs, but would you still consider that as a negative divergence?
Well, to my mind, I would say yes. It's a negative divergence until proven otherwise. You're not getting confirmation of the price action in the momentum oscillators. And we've talked about the weighted indexes, and until those oscillators come back to new highs and confirm the higher highs in price, technically it is a divergence, I think.
Yeah, it's absolutely right. And basically, based off of this breakout, given this consolidation pattern right here where we're just moving laterally, what's the projected, and this isn't going to go there in one day or 1 week, but what is the projected target? Well, it's about 4,700. It would be the projected target. Let's say up here about 46.81. Now that this level here, the 44.83 level on the Nasdaq, now becomes a support level, and for getting close to 40, that right here, this 46.80 level is only a whisper away from the all-time high on the Nasdaq. And I know that there's, if you would have asked somebody 5 years ago whether or not the Nasdaq was going to make it back up to the 2000 highs, I think the majority of people said no way. But there you have it. Did you know that we were that close, Mike, to the all-time high?
Oh yeah, I know. I tend to look at the Nasdaq Composite, not the Nasdaq 100, and the all-time high in 2000 on the Composite, it was not a closing high.
Yeah.
It was an intraday high, and I think it was in March of 2000. Was 5100 something, and we're right back right around 5100 now.
Yeah, we are.
15 years later. And also another interesting point, in 2009, March of 2009, I think the Nasdaq Composite bottomed down around 1200 something.
Yeah.
So we are now up more than 300% in a period of 6 years, off of that low, which is stunning.
Yeah, and so with this level of extension from the 20-day moving average, let me pop up one thing here. I want to be looking at. Sorry about the. There we go. There's the 50. As you can see, we have now extended away from the 50. Apple, after Apple, well, I won't speculate. I was going to say after Apple reports, it may push higher than that. But as you can see, we're close to a point where we need some kind of a retracement back to the moving averages. But as you can see, that 50-day moving average from the beginning of the year, once it took off, it's been a constant uptrend. And I made that statement about this. This is the Nasdaq Composite. We'll go back to the Nasdaq really quick. Made the comment on that on Thursday, I believe, that we now have gotten the moving averages into gear, and they're all pointed up. But at the same time, the reversion to the mean will kick in at some point. It won't. Yeah, Gino, you're right. Gino points out that the Dow was down 323 points last Friday. Wow, what a difference a week makes. Anyway, that's where we're at with the indexes. Mike, you got any other comments on this? I think this is a perfect example of, because the Nasdaq is a weighted index of exactly when those stocks with the greatest weight move, they can shake the index up significantly and make it move also.
Well, yeah, and that's what we're seeing here, most especially in the Nasdaq, and I just, when we're all looking at that, I think we need to keep that in mind and maybe take a little bit of this price action with a grain of salt, knowing that it's being determined by just a handful of relatively bigger, more important stocks, at least more important in terms of their influence on the price action of the indexes.
Exactly.
And before you leave to go on to individual charts, since we spoke about a little bit earlier, longer term charts, it might be useful, and I think I do have a comment to make on the monthly charts.
Okay, hold on. That means I have to pull up a monthly chart.
That would be helpful.
Hold on, let me get rid of those drawings. There we go. Let's go to I know I got a monthly side by side here somewhere. There we go. This is a monthly and a weekly. There you go.
Yeah, okay.
Hold on, let me hide the drawings for a couple of seconds here. There you go.
Okay. Well, I mean, the observation, and actually, is there any way on your month? There you go. Thanks. Just get some more data in there. Um, noticing the divergence in the true strength index on the monthly chart.
There you go, right here.
Yeah, right here, where we are on the hard right edge of that chart. Also, one of the observations I noted, and mostly I was looking at the S&P and the Dow, and not the Nasdaq so much. And I was looking back at 2000 and also 2008, and there was a very similar situation with the S&P and the Dow during those times when the market was topping, where the monthly charts were getting real choppy, and there was a price consolidation going on, which took several months to play out. I mean, this went on for in 2000, 2008, for 6, 7, 8 months, where you kept touching these areas of strong resistance and not making really any progress until things finally started breaking down. And a lot of people remember back to the dot-com bubble in 2000. But if you look at the chart, you'll actually find that the year 2000, for several months, it was pretty flat.
Yep.
I mean, you were up around, the 1500 area on the S&P, and it stayed there for months until it finally started to break down towards the end of the year. And then it kind of got ugly in 2001, really. And we're seeing the same kind of thing happen now, where we've been stuck in this price range for several months.
Yeah, I'm going to leap forward. There we go.
The S&P's been kind of butting its head up against 2100 and change for 3, 4, 5 months now, and not really making any progress.
Yep.
And we don't know how this is going to get resolved, but we know how it's been resolved in the past. And it's just an observation and not a prediction of anything, really. But I was kind of surprised to look back at 2000 and see that it really wasn't all that bad. It didn't get bad until 2001.
Yeah, exactly. And I'll roll back here to that point in time, which was always very interesting. Here's basically the range. This is the year 2000 right here, and here's the range Mike was talking about. Is basically, and this is where these candlestick bodies really come into effect. Just take the bodies, draw your lines across the bodies, which that one was a little bit short, but as you can see, we were stuck in this range, and all of a sudden it finally resolved to the downside. But look at the time it took. It took almost a complete year to get the resolution.
That's my point. Sort of a topping pattern where you get price consolidating and not really able to make any progress. And on a monthly chart, that might be 6 or 7 candlesticks, but that's 6 or 7 months until the situation resolves itself in one way or another.
Yeah.
And just an observation.
Yeah, and the other thing
I don't know that it can be extrapolated to what we're seeing now.
Yeah. Well, again, I think the level of government interference then was a lot less than it is now. And I mean, they're working their rear ends off to make sure that this doesn't happen again. And in reality, but anyway, what we're seeing here is this is what a true strength indicator has rolled over and is starting to meander down. It hasn't accelerated, but look at since 2014, the beginning, the momentum on a monthly case has been getting weaker and weaker and weaker. So Dorothy asked a question, drawing a line on the lows of the TSI makes a flag pattern. I'm not quite Dorothy, basically you can draw on the lows on the way coming down, but I tend to, like, if I was going to be drawing a pattern on the TSI, let me show you, I would basically take this level here and I'd make a big box. Now I would take this, then draw those down to the peaks. Now you can also draw from this way going up, and it works really well on the shorter term charts. You can also connect that, and that line right there where it goes below that uptrend is what it's telling you that, okay, the trend has kind of changed. I hope that answered your question. So yes, and that's one of the cool things about learning how to use the indicators. Learn to use them from the aspect of the patterns that they make. You can help you be patient a little bit, and so go ahead, Mike.
No, I was going to say I think Dorothy makes an excellent point. I mean, trend lines on indicators, on oscillators, are certainly valid. They are as valid as they are on the price action. And we do see on the True Strength Index that the uptrend line drawn along the lows over the past several years on the monthly chart, that uptrend line has been broken.
Yep.
Certainly, but being a monthly chart where you only get one data input per month, certainly it takes things a long time to play out. But it's a really good observation and a really good point to keep in mind, I think.
Yeah.
Very smart.
And one of the other things is that you like it when it does these little peaks like this, because the peaks are easier to draw trend lines off. And I'm always amazed on the indicators on how, okay, like this is a monthly chart, right? Well, we drew this, and while I was coming down here, you're telling me, not now, not yet, not yet. But then you get to start to roll back up. And where does it actually cross the line? The next month, as it goes into a significant, well, this has been 2008, 2009, when the market went back into its uptrend. So that's valuable information to learn and know about. And
yeah, and I would even make the comment that horizontal lines of support and resistance on the oscillators, are trend lines of a sort also. And on the monthly chart of the S&P on the True Strength Index, it looks like we've had some horizontal support at the plus 50 level.
Yep.
For several months, and we've broken that also.
Yeah.
So I think it's a really, really smart observation.
So here's just a reminder what the pillars we focus on in the active trend trading system. We always look to top quality IBD stocks and or index ETFs or leveraged index ETFs. We provide trigger points for getting in, and then exit action points being both targets for profit and also stop losses. And then we use one of two, we basically are buying or going short the stock or index ETF. And then we'll throw in some special strategies that include some options, and we always provide what to expect. Here's several stocks. If you could learn this pattern, if everybody could just learn this pattern, Dave Johnson is a guy who Mike and I have studied with for quite some time. But if you just learn this little flag pattern, bull flag, coming down to a certain level of support and then breaking up that pattern there, and look for the stocks that are showing that, those are really big money makers. But we're getting a lot of resets with the earning runs. YY was a stock we got in on the 17th, which was this day right here. And we've ridden that now up and hit our T1 at about 65, and we were in at about $60. But rebound back to swing high is your first target. And then if you get additional earning runs after that, that's a big plus. But I try to time my earnings pre-earning run trades to where I am exited the position prior to earnings. So YY is a stock we've continued to identify this week. I know that there's several folks who have been getting in and out of or getting into YY with some additional shares. Good deal. VDSI, Tesla were highlighted this week. Mike, I am still, this is in my own private account. I did not put this out as an alert, but I'm right now, got the June 52 put on the China. Just in case it breaks down. And another trade that I'm looking at potentially is to go ahead and go out and buy that leap on the spiders with the anticipation that we may very well get a good correction between now and January of 2017. And what I'll do,
Talking about buying a put leap?
Yeah, a leap put or put leap. Yeah.
Leap. Yeah.
And what I'll do is just as the time goes on, I will sell puts against that to basically keep the dollar cost of the put down. But if we get a significant, and we were chatting earlier, if we get a 30%, 40%, 50% pullback, that will be a really good trade. And if not, there's 91 weeks between now and 2017, January 2017, and I can sell a little bit of premium every week against that. And even if I just collect 50 cents per week or $50 per contract, it will more than pay for itself times two over that time frame.
If you have the discipline to do that every week, and if we do get what a lot of people think is going to be the inevitable pullback, it could turn into a very, very profitable trade.
Exactly. And I'm not going whole hog on it, just 3-4 contracts and just working on it from there. Here basically we exited the first half of this trade today, and here's a trade on the YY. Picked it up, and it was about a 7.4% gain. We're also tracking what we're doing down here, the longer term. We bought the YY May 6250 call with the anticipation as we approach earnings, you will get a volatility surge on that, and also we've gotten some nice uptick since we got that when it was down at when the price of the stock was about $60.45. So these are the trades for April so far. So that is basically it for today, Mike. I want to say see you next week and have a great weekend, everybody. And I'll be hanging around to review some stocks. So, Mike, you got anything to sign off with?
No. Thank you. It's good to chat with you, and I'll talk to you later.
So, excellent. Okay, Mike,
right.
Have a great one, man.
Okay, you too. Bye.
Okay, everybody, let's see what we've got here. So, Harry, semiconductor VGO swings are down sharply with no news. Yeah, Harry, I have been watching all three of those, and Harry says basically that the semiconductor stock, especially the Apple suppliers, AVGO, SWKS, and XPI, are down sharply with no news. What do I think? Are people afraid of Apple's earnings on Monday? Perhaps they could be exiting. They don't want to exit Apple, but they will exit out of the some of their suppliers, because they know if Apple disappoints, and so they may be just locking in some. So absolutely, you're getting and who knows? This may be a predicate on what may be going to happen with Apple on Monday. We shall see. But basically for AVGO, you've got a high volume move down below the 50-day moving average, and now it is basically into a downtrend, as you can see here, and a downtrending channel. So you can just draw that line there, draw a parallel line to that, which is about there. When it's already had earnings, and so it's selling off. It may come to this level here at the lower end of the gap up window, and that may be a place where it finds support and bounces. And so I'll just take another look at it, because WKS was one of the stocks that I was definitely interested in earlier, but I think it also broke its support today. Yes, it has. It's again in that nice little downtrend. Volume weak, weekly momentum down, TSI down. True strength indicator here over here is down in the lower level, and as you can see, the momentum has fallen off of this, but not a huge volume sell-off. And so, and I'll just do NXPY and XPI. Same. It is approaching a level that we know it has a level of support there at $93, and the next one will be down here at $95. Its selling volume has been above average, and it has earnings coming up on the 30th, which is next Thursday, and it looks like it is Thursday before market open. So let's take a look at. So very intuitive, Harry. That's so QLYS. Not seeing a lot there, Gino, unless you have, I think you're already in this trade, I believe. And so here's some of those flags I was talking about. If you can find these flags, they are bouncing off a level of support. Same play. Oftentimes it'll take you at least back up to the previous swing high. So are you long this one, Gino? And then take a look over here on the weekly. Yeah, it is at a level of resistance. And okay. And so if it can push up and close above the 94.06 level, then it's probably got a little bit more legs. But as you can see over here, look at the momentum is actually coming out of this as it's moving higher, and you've got negative divergence on the true strength. And so with earnings coming up on the 4th of May, it may get a little bit of a kick to the upside. If not, it might be a time to say, hey, I'm going to take some profits on this. IGI. Basically, it's in a process of doing a new consolidation. This may be a pullback towards the moving averages on the weekly, but it is definitely at a level of resistance. It is putting a spinning top doji, which is a sign of indecision on the weekly chart. And what's it doing over here on the daily chart? It's gone up and hit this level of resistance, and now is reversing. It has not broken and closed below the 8-day yet, but I would say if you are long this, that if you lose 22, that may be when I say lose, if it goes down and closes below 22, you might want to take a little bit of profit off the table. Okay. CMCM. Cheetah Mobile. Yeah. So looking at Cheetah Mobile earlier. It's got earnings coming up about on June 2nd, and it is basically posturing here. You can come in here. If I was looking to get into Cheetah, I would be looking at a retrace back down to approximately that level, below 22, and then a bounce, or 222, and then a bounce. And the reason I say I would look for a pullback is just basically looking at the weekly indicators, looking like they are, losing a little bit of their vim and vigor. Same thing over here. Whether or not it does pull back down to the 22 level remains to be seen. But I would look for at least a bounce and a retrace to the, or let the moving averages catch up with it. and be able to jump on that then. Nice looking chart. Look at all this nice volume coming up as it came out of this consolidation here and launched. And it's digesting this straight up move, and it held up very nice. Look where, right at where it did its breakout. So that's one of those you kind of put an alert in at, say, 2250 and an alert up at 25, and as it bounces between there, but it's definitely worth keeping a look on. AMBA. AMBA was looking a little bit weak this morning. AMBA, there we go. And it too, rolling over. When's earnings on this? 3. So earnings are out here in the first part of June timeframe. And this is pretty classic topping aspect. It could be, it could go sideways here at 70. Or it could drop. If it drops 70, we're probably looking at somewhere between 60, say 67.50 and 65, or even down to 63, which was the original breakout. But right now, a little bit of upswing on the selling volume, and pay attention to the momentum indicator when it starts doing that, and it just dropped below the 0 line, which could mean that it has some more downside pressure to go. When the momentum indicator starts doing this, where it's just kind of not a defined trend, it's showing that the stock is either doing one or two things: digesting its previous gain, or looking to do a significant pullback. Would AMBA be a buy? Gino, I'm going to basically say it depends on the pattern that Ambush puts together, and so let's see, what was we covered Swanks or SWKS, Skyworks, and so yeah, Tracy, on that one, yeah, as soon as it dropped, let's see, I'm going to take a look at this one more time. SWKS. Yeah, as soon as we drop back below this line here, I mean, it may very well bounce right here off the 50, but this is here's a small little flag that actually is a bear flag because it had started a little bit of a downtrend. As it broke back below, and if it didn't hold there, because that's where we were looking, okay, is it going to hold there, or was it going to hold here at 95? And it fell right through 95. And so if you take that trade there off the, at approximately 93, when do you know you're wrong? You know you're wrong as soon as it breaks and you get a significant break below the 92, 98 level. And so you can minimize your risk by just paying attention and saying, hey, I'm out of this, because the sooner you know that the stock's not doing what it's supposed to do, the better, and just, take the small bite and get out, and then wait for it to set up again. Tesco. It is, okay, that was a return from earnings. The way I'd be looking at Tesco right now is I would draw my line across here or here, because you've got 2 levels of support. But you've got that level of support there, and also the breakout level of support off of that high. And so what you may have in there is a support zone where prices could move back into there and bounce off of that. The moving averages should be up there, by the time it pulls back into that. But right now, hanging man, followed by a bearish engulfing so far today. And so it may be just retesting the breakout, and you've got really nice breakout volume above average moving in with earnings. So let's see who gave me Tesco. Yeah, Aaron, if you're in Tesco, I'd be basically watching the 8-day moving average to, if I get the close below that, or or if it closes back below 89.37, that's telling you that the breakout has failed. And by Apple, Susan wants Palo Alto Networks. Palo Alto Networks was holding up fairly well today, earlier. I like the breakout on Palo Alto Networks, but the follow-on volume after the breakout has been kind of below average, and so I'm looking for Palo Alto to do this. I would like to see it come from here to here and then go. And about 60, so they say 65 to 70% of all stocks that do break out like this will pull back towards its breakout point. Doesn't have to reach it, but you'll see a little bit of a pullback. And sometimes the pullback is nothing more than just going sideways for a while and then breaking out. But as we see, momentum's coming out. We may get a rollover on the true strength. And this is one of those that Mike and I were talking about. You've actually, your divergence on your true strength is negative, but your momentum is just staying kind of flatline, which is good because it's above the zero line. So it's just basically saying, hey, I'm not selling off. I'm just maintaining it, which that momentum is what helps keep us moving in the upward direction. Data. Okay, data had a nice little run up. It is approaching earnings. It too is one of those that has done a breakout, or has it? Depends on where you draw your breakout line. If we're taking the breakout here, yes, it has. I mean, this would be the old cup and type handle. The fall right here is kind of too deep to be a legitimate cup and handle, or but then you've also have that level there that is functioning as support. So it's either doing one of two things. We're getting up here close to a past level of resistance. Will this be a double top, or a consolidation and a pullback and then a move higher? And it'll be worth watching. We'll probably know a lot more after we have earnings coming up in the first part of May. If this one was to pull back, what kind of volume does this have? Yeah, pretty good volume, above 500,000. If we get a little bit pullback back here to the 100 level, or even back to the moving averages, like over next week, then it may provide a nice little run that would take it above this level prior to earnings. Let's see, let me take, okay, a couple more stocks and we'll call it a day, folks. Alta. ULTA. Okay, pushing higher. What's going on over here? We've got a divergence on the momentum on a daily basis, with divergence on the true strength indicator on a daily basis. It's pushing to this high. The TSI is up above 50, and the momentum is saying, hey, I may still want to push up, but you've clearly got a level of support between the 148.50 and the 150 level, and resistance at the top of today's candle. And let's just make sure I won't go there. So last one will be Exxon was looking, this is Intrexon, and it has earnings coming up on the first part of May also. And so it was looking to do a breakout of this little resistance here at the 45 level, did not make it. So we're working on a couple of things here. We have this trend line here that it needs to break up through. And so when we come back down to the 50-day and rebounds, Or it may pull one of those that, like SWKS is pulling right now, where it actually drops this level. But you can go over here and look and say, okay, we've got good, strong support at 41.20, and that's when it would become interesting, unless you're already long. If you're already long and you drop and we get a close back below the 20, the 50, or correction, the 20 or the 8-day moving average, and then it breaks through that, you're just going to have to watch it, Tracy, and say, hey, choose where you want to, make a stand, either just below the 50, or if it breaks down from here, because this is a little shooting star pattern, and so it may come back and recycle here between 42.38 and 41.11. Does that work for you, Tracy? Awesome. Hey guys, that's gonna be it for today. Thank you all for joining. Have a great weekend, and we'll chat with you next week. Thanks a lot. God bless.